Hi, everyone. It's Joe Veneri, the host of Fit Insider, the show where I talk with the entrepreneurs, executives, and investors who are redefining the business of fitness and wellness. Today, I'm joined by Aarti Kapoor. Aarti is an investment banker at Goldman Sachs, covering consumer and retail clients, including high-growth, health, wellness, and lifestyle companies. In today's episode, Aarti and I discuss the evolution of the wellness market, the filters she uses to assess deals, and the impact of digital and connected fitness on the future of the industry. I had a great time speaking with Aarti, and I hope you enjoy listening. Let's get into it. Hi, Aarti. Welcome to Fit Insider. Thanks for joining us.
And thank you so much for having me. I'm super excited to be here today.
That's great. I'm excited to chat. And jumping right into things, looking at your bio and the things that you've accomplished, you've been called a trendsetter and trend spotter who really saw the opportunity in fitness and wellness long before anyone else. How did investment banking and the fitness industry kind of converge for you?
So my foray into covering health and wellness as my day job actually happened pretty organically. And I'm certainly glad that it did because it's made investment banking a lot more fun. I ended up being just a really good case study of how the consumer was changing, both in terms of spending more time and money on health and wellness. And this really helped me to identify the trend very early on. I was living in New York in the Flatiron district, had a gym membership that was just a part of my life, not a big part of my identity or how I spent my time and money. But then stumbled upon a boutique fitness studio, and it was my first interaction with boutique fitness, and fell in love. And, what I swore was going to be just one class, became a 5-pack, a 10-pack, and then an unlimited membership. And during the time that I was going to that studio, which by the way, entailed one a days and sometimes two a days, I saw the room filling up, and I started to recognize the same people coming back and saw that communities were being formed and that something was really different with this experience. Had a bit of an aha moment during one of the classes when I saw that 50-something spots were full, and did a little calculation in my head and said, okay, 50 plus spots in a class, $30-something per class, one instructor. And if you can manage to do this several times a day, well, that's a really darn good business model. And realize that, even though some of these companies were small at the time, they were growing so quickly and could very soon be our clients from a banking perspective. So, that morning after class, I ran into my mentor's office and asked, why aren't we covering this space? And naturally had a little bit of educating to do because the space wasn't really all that formed at the time. And got the green light to pursue this as a pet project. Burned the midnight oil on health and wellness, but very quickly my pet project became my full-time job. And I think there was a little bit of right place, right time. But honestly, being a millennial, female consumer in New York living Flatiron district was a great way to get into the scene very early because I was really the target consumer. So it's a confluence of all those factors, but I sure feel lucky that it all happened.
Right. And framing that up, what year was that about?
Around 2014 or so.
And
a little over 5 years ago.
Right. And so thinking about, maybe the reception that you did or didn't get when you rushed into your mentor's office, it sounded like it went well. What type of convincing did you have to do versus maybe how obvious things have become since then? Was it that obvious at the time, or was there a lot of questions kind of around the industry?
Yes, I had a lot of questions to answer and a lot of convincing to do. Today, the health and wellness trend seems so obvious. We go to the grocery store, we see tons of clean label and better for you products. We see healthier alternatives on menus. Fitness studios popping up on every block. So there's tons of anecdotal evidence. I didn't have the benefit of that when I started to cover the space because it's really in its early innings. So most of the businesses in boutique fitness and nutrition, et cetera, were all fairly early stage and subscale. So the folks that I was convincing at my firm didn't have that anecdotal evidence in their own personal lives to really see why this market was so relevant. So I would say the key questions that I got were twofold. One was around the longevity and sustainability of the opportunity. So were these businesses just passing fads, or were they here to stay for the long term? And then the second question was really, how big can these businesses be? So sure, you can have a great studio that has one or two locations, but how big can a boutique fitness business ultimately be? And what that really meant is, can these be clients of ours that will garner institutional interest and also be able to pay us fees if we get a deal done? So those were two questions, and two great questions that absolutely needed to be answered. The market hadn't gained that much market research activity at the time, so I was really relying on listing a bunch of key trends in terms of why the market was going to be sustainable. So looking at consumers and their preference for experiences versus things, and consumer education around health and wellness and prioritization of that category, etc. And then for the transaction opportunity, there were a couple businesses that were scaling rapidly, so really looked at those as case studies and a proxy for the broader market. So there were certainly a lot of questions. Luckily, the growth and the pace of growth for these businesses was so great that over the time when I was covering this in the early days, I had more and more proof points very quickly.
Yeah, thinking about how it has matured in the direction of being sustainable, what are some good examples of deals and opportunities that have emerged in that direction? What are some of the things that may have fallen off that didn't prove to be as sustainable?
So the topic of sustainability and longevity is a really important one that I spend a lot of time thinking through, because it has direct implications on how I spend my time covering companies. We want to spend time with companies that have sustainable and attractive business models, but also sit in market segments that are here to stay for the long term and have the right long-term megatrends behind them. Because it's ultimately this confluence of a great business model and a good market dynamic that will garner the most institutional investor interest, which means we can get a deal done. So, rewinding back 5 years ago when I started to cover the space, I thought, okay, where are consumers going to start in their health and wellness journey? And it was fitness and healthier food and beverage. And so I started to cover these spaces pretty early on, and luckily picked the right two pillars, because I'd say those two are two of the most established. I think they have become the most established for a couple of reasons. So as I mentioned, there is the consumer demand component. It's where consumers start in their fitness and wellness journey. And then it's the supply side component, which is that there are pretty low barriers to entry in a lot of these categories, and particularly call out something like boutique fitness, where you just need a couple thousand square feet to get your own business started. And that's why we've really seen such an influx of new entrants in the market. So, from a number of businesses standpoint, from an industry revenue standpoint, from a scaling and, maturity standpoint, I'd say these two are the most established verticals. But there's so many up and coming verticals that I would call more emerging, that I'm really excited about. As I mentioned, the consumer looks at wellness as health and as multidimensional. So, while we may start with fitness and eating better, there's a huge mental component. And also with all the physical activity we're doing, there's a restorative component. So as a result, we've seen industries such as mental wellness and physical recovery and the sleep economy really begin to gain traction in the last couple of years. In the mental wellness worlds, we've seen the mindfulness movement really gain traction through Calm and Headspace, and destigmatization of therapy and democratization of therapy with businesses like a Talkspace. And then sleep is top of mind as consumers seek a better night of rest. And when you think about total addressable market, that one is huge. Very recently we just witnessed the Casper IPO, with the company raising $100 million in the public markets to take on what they define as the sleep economy, which is estimated at $80 billion in the US and over $400 billion globally. So huge opportunity there. And there are a number of other verticals that are emerging as well. I'm excited about, female health as an example. As consumers are getting married later and have more of a need for fertility support. So there are a number of emerging verticals that I think are just getting started as the consumer thinks about that multifaceted nature of health and wellness. And then even within fitness and, healthy food and beverage, there's a ton of runway ahead. Fitness really has grown in the last several years in the brick and mortar aspect, but digital fitness is just getting started. So very much excited to see where these emerging verticals end up when, we do our look back a couple years from now.
Right. And when thinking about now how prevalent wellness has become, fitness and wellness, even if you're looking at some of those more established verticals, how do you begin to assess them or vet them? Are there specific filters that you look at to see, hey, is this going to be something that can get to the level, the opportunities, the size that we need it for the investment banking standpoint? How do you assess those things, and what are some of the specific filters?
Filters have been very important, and increasingly so with each passing day covering the health and wellness industry, because across verticals in health and wellness, there's just been an influx of new entrants in the market, probably due to a confluence of factors. It's a really fun market. It's a growing market. Barriers to entry have been fairly low. So a lot of entrepreneurs, whether or not their idea is all that innovative, have jumped into the market because of these attractive growth prospects. So there are literally several hundred companies that we could be covering day to day. And again, it comes back to who has a sustainable business model, can scale in the long term, has longevity through consumer cycles, et cetera. And all of these factors will ultimately dictate whether or not there will be institutional interest in an IPO, in an acquisition, or for an equity raise. So let's just use boutique fitness as an example because it is such a crowded vertical. There's several parameters that we think through. So first and foremost, brand, right? This is how you differentiate yourself in such a crowded market. So thinking through brand equity and brand affinity from the consumer, if there is that stickiness factor. And today's consumer really cares about authenticity. So there's also that question of, are there clear brand principles and are they reflected in the day to day, both operationally and then for the end consumer? In addition to brand, of course, there's the strength of the actual product or service, right? So is there strong programming? Is there high quality experience for the consumer? And is it consistently replicable? And then also, as we think about different modalities within boutique fitness, is there fad risk around a specific modality? Will it go out of style? Next, let's think about units, right? So there's a unit economics point, which is how productive are your units from a revenue standpoint, from a margin standpoint, and how uniform is your unit economic performance. So when you are looking at comparable studios within a portfolio, do they perform similarly, or is performance all over the place? Because that portfolio complexity really detracts from how attractive a company might be. So in addition to the absolute and relative performance of unit economics, there's a question of proof of concept. So we're in a very fragmented market with a number of subscale brands with 1, 2, 3 locations in their home market. And the biggest hurdle has been, can you scale to other markets? Can you compete effectively in those other markets? Can you resonate with those consumers as well? And then thinking ahead to growth opportunity, which is obviously, the crux of why investors are putting money into these businesses. There's a question of TAM, total addressable market. So what does the end consumer look like? Is it men? Is it women? Is it both? What age ranges? What psychographics? What fitness, capability levels? And so how broad can that market be? And then related to that, what is the white space ahead? So, how many units can you have ultimately down the road, and where are you in that unit expansion trajectory? Making sure that there's enough runway for you as an investor during your holding period, but then also looking at enough runway left when you're trying to exit that business opportunity so that the next buyer still has enough growth opportunity ahead. So, number of parameters: brand, offering, unit economics, proof of concept, TAM and white space, and then various other factors as well, operational infrastructure and management team, but some of those can be engineered from the investor's side. So, there may be hundreds and hundreds of companies that have come onto the scene and grown rapidly over the last few years, but when you ultimately put them through this set of multiple filters, the list of brands that are attractive to institutional investors narrows very quickly.
Absolutely. Achieving any combination of those things is a challenge. And when you think about all of them and then opportunity for future growth in taking into consideration the number of competitors, not only in the, whether it's boutique space or even brick and mortar space, but also the connected and digital fitness space. It makes it even more complicated. For the sake of some of those filters that you're using, what does subscale kind of qualify? You mentioned a few studios in their home market, but is there a number or a number of regions or locations, or is that vary depending on the concept?
So the word scale comes up in every conversation many, many, many times. It's a huge area of focus. There are probably two ways you can look at scale. One just being, business scale in terms of geographic footprint. So how many units do you have and in how many markets are you in? And then there's financial scale. On the geographic footprint side, I would say the vast majority of boutique fitness brands have tens of locations, if not fewer. So to be in the 75 or 100 unit mark for owned and operated businesses and several hundred unit mark for franchise businesses, that really indicates scale. But there's no magic number, and it's a combination of unit count as well as the types of markets you're in, both from a tier 1, tier 2 standpoint, as well as geographies. And there are multiple buckets of investors that we work with. There are growth equity players who invest in smaller, high growth businesses. There are buyout investors that may look for more mature businesses. And then there are strategics that span a wide range of sizes. And so for growth equity players, they may want to put $25 million of capital to work. And so their definition of scale will be different from what buyout players look for. They may want to put several $100 million of money to work. And then strategics will look at their own businesses and what's relevant for them. So really, scale is defined in a very subjective way, depending on which investor is looking at an opportunity and what their bite size really looks like. That said, obviously, the two definitions of scale are related. The larger footprint is geographically, the larger the business is financially. And then if you really want to throw a wrench into all of this, investment bankers have their definition of scale, which is how can I work on a transaction that actually allows me to get the fees that I need to get paid? So as you can see, it's a multifaceted answer, and there are multiple components of scale. But I'd ultimately say it's financial scale, which is dollars, and it's geographic scale, which is footprint, and both are incredibly important.
Yeah, it makes sense, and it varies across the spectrum. If you're looking at some of the more established verticals like fitness, for example, the formula seems pretty well calculated. It varies, but there's certain buckets and measures that you're looking at. With the number of verticals that are emerging and the different things that could be a trend or a fad, how do you assess those? When you're looking at it from maybe wearing your consumer hat, it's you're excited about them. You may be a user of them. You can certainly see the interest, but then trying to run those things through your various filters, maybe there's not a formula for it yet. So how do you kind of hedge in that scenario?
So this is a great question. We talked about two of the more established verticals being fitness and healthy food and beverage / nutrition. In those cases, there are so many precedents that you can look at of successful brands that have scaled and what were the right characteristics they had when they were earlier on and their trajectories that allowed them to really grow and be successful businesses. Unfortunately, that precedent analysis doesn't really exist in these emerging verticals because there are so few players of scale, and these verticals have only been around in this new form for a couple of years. So, sleep and recovery and mental wellness, we're still figuring out what the market dynamics look like and what characteristics of successful companies will be, and also what consumers want out of these categories. So we know consumers want a better night's sleep, but what are they willing to spend on and what aren't they willing to spend on? We know that consumers care about mental wellness, but is this something that's monetizable, or is this something that they're going to work on their own? So there's a lot still being figured out, but I would say the filters are probably not far from what we identified for something like boutique fitness, which is taking a step back. Business models might be different, but it's strength of brand, It's strength of your product or service, and replicability of that. It's economics. So, we talked about boutique fitness economics and from a brick and mortar standpoint, but there's the economics of e-commerce distribution, and economics of, wholesale and, retail partner distribution as well. So looking at economic model, and then, TAM and white space ahead. So it's probably pretty similar. I would just say though that with some of these earlier stage verticals, there is not so much urgency from our side, and we are taking a little bit of a wait and see approach. So we're following the market closely, and we're paying attention to trends because they're relevant to our clients, and we want to stay ahead of them. But we don't need to jump into transaction activity or try to create a market that doesn't yet exist. We're still waiting to see how some of these players grow, evolve, and scale.
Yeah, the sleep and the meditation, mindfulness, mental health are all certainly things that we've been tracking as well. And when you start to look at, I think both Casper and Calm recently said that, Casper wants to be the Nike of sleep. Calm wants to be the Nike of mindfulness. So everybody's chasing that, like, how big can we get that addressable market as one of the pillars that you talked about evaluating and thinking about how big they can get.
So the topic of access is a really important one. I'm glad you brought it up. It's been the subject of fierce debate in the industry because when all of these trends got started, many of them got started in tier one urban hubs like New York, LA, San Francisco, et cetera. And so they were naturally catering to many consumers in those markets and had, in many cases, higher price points. And so there was this notion of, is wellness just for those with a high socioeconomic status? I think the great news is the answer is no. And a lot of these businesses across health and wellness verticals are becoming more accessible with time. Now, accessibility is something you can think about in a couple ways. There's obviously the financial access point, which is something affordable. But then there's also the geographic access point. Boutique fitness started off in, a handful of cities, and a lot of consumers wanted access to these concepts but didn't have a studio to go to. And so there's a question of, is there geographic access? So in boutique fitness, we've seen a great success and run of studios scaling to tier 2 markets. It's been really exciting. 5 years ago, there was really an investor skepticism around that and a strong belief that these studios could only be successful in tier 1 markets. We've luckily had a couple of really great case studies that have proven that this is not the case and shown that the white space is actually much larger. Brands like F45 and Orange Theory and a number of brands in the exponential fitness portfolio like Pure Barre and Club Pilates, et cetera, they all have several hundred or in some cases over 1,000 locations and have been very successful in tier 2 and even, quote unquote, tier 3 markets. So I think boutique fitness has become a lot more accessible geographically and financially. And then, the value segment in fitness is really important and doesn't get enough airtime in some of these conversations. And I think that's maybe because the brands have a little bit less pizzazz around them. But the Planet Fitness business model, Planet Fitness is very financially accessible at $10 to $20 a month and very geographically accessible with nearly 2,000 locations. And they've defined their white space as 4,000 units in the U.S. So the value segment has definitely been very helpful in making fitness accessible. And then digital. So, digital obviously is still in the early innings, but when you think about financial and geographic access, yes, there are the connected fitness business models that are more expensive and have the upfront purchase that is, fairly hefty at, $1,500, $2,000 or more. But some of these streaming models are extremely affordable at a couple dollars a month. So when you think about access, almost anyone can access them financially. And then, of course, from the convenience standpoint, the at-home fitness market is really at the epitome of convenience. And then we spoke a little bit about mental wellness and, the example of therapy, which obviously is something that's normally very expensive and comes out of pocket for the consumer. But there are businesses like Talkspace that are trying to make therapy more accessible. So yes, 5 years ago, Health and wellness seemed like it was, reserved for certain socioeconomic status, but, whether brick and mortar fitness or digital fitness or mental wellness, or a number of other categories in the industry, we're seeing this expansion either by default because businesses are scaling or, access being a deliberate effort as certain business models are specifically trying to become more accessible, and have been very successful in doing so.
Yeah, and I think too, one of the things you mentioned, especially as it relates to mental health, was kind of removing the stigma around, whether it's depression or loneliness and some of the things that are associated with that. One thing I wanted to touch on was you have all these companies in the wellness boom and fitness continuing to be on the forefront. And then the question of like access, how do we get more people to be able to take advantage of these things, or maybe make sure that it's not just for a kind of high-end market? You mentioned Planet Fitness. There's obviously headlines around there's a gympacalypse. The middle tier gyms are getting pushed out. Then even boutique fitness studios. There's a boutique fitness bubble. Can we make sense of what's happening in the brick and mortar fitness space?
So the gym and health club category has evolved significantly in the last couple of years, and I would say there are probably two primary phenomena taking place. One being that the pie is growing, and two being that the pie mix is shifting. So on growth of the pie, the fitness industry is growing and has grown consistently for several years, even through the last recession. It's been really attractive as a category as consumers are spending more on the category. Penetration rates are going up. And has all the right megatrends behind it with, growing consumer education around health consciousness, growing consumer focus on experiences versus things, cultural shifts that have made a fit lifestyle a very aspirational lifestyle, fitness as a form of community, et cetera. So all of these are coming together, making the pie larger, and that's been very helpful to the industry. But the complexity part comes in terms of the shift in mix. And that just means that there are different categories in health clubs that are growing today than historically were the ones growing. So very simply mapping out the landscape, on the gym and health club side, you've got value, mid-tier, and premium players, and then boutique fitness, which obviously is a newer part of the industry. Historically, mid-tier gyms owned the landscape. They had most of the market share, and that one-size-fits-all approach worked for consumers. As consumer preferences have evolved and there's been that focus on specialization and retailer expertise, it's really resulted in a bifurcation of the market. So you have value segment that's doing really well, like a Planet Fitness that's just catering to consumers at the beginning of their wellness journey, and the no frills approach and financial accessibility works really well there. And then you have the high end gym model like a Lifetime or Equinox, which has everything under one roof and is doing everything really well. And that has worked as well for a very different consumer. And the mid-tier, unfortunately, is getting squeezed. And most of the players in the mid-tier category are being forced to reinvent themselves and consider different business models and really adapt to these consumer shifts. And then, of course, we know boutique fitness as a bucket is, relatively new, and it took a lot of share from the mid-tier as well as, to some extent, some of the premium offerings in the market. So the good news is there's room for multiple segments. The value consumer is very different from the boutique fitness consumer, as an example. So there's room for both the high end and the low end to exist. Unfortunately, mid-tiers do need to reinvent themselves in order to stay relevant. But overall, I'd say the outlook for gyms is still very bullish. There's room for multiple business models. It's just that there is a shift in mix, which we've seen notably over the last several years, but the pie is growing, and that's a great thing.
Yeah, I think it's so interesting, and especially looking at the Lifetimes and the Equinoxes of the world, both taking their own approach to continuing to evolve what it is they're offering the consumer, and just again, almost back to that TAM point. It's like, how much more can we provide, and what does this offering look like? It certainly seemed like a focus of theirs as they continue to find where they're going to add value going forward. And I guess on the flip side of that would be the digital and connected fitness landscape. You talked a little bit about it, and to the point of it's on the high end, and it might be seen as maybe a price point that is not accessible. But then on the other side of that, you have a number of companies, be it Inaptive or Freeletics, that are democratizing fitness at around $10 a month. What is the kind of long-term outlook of the digital and connected fitness space? I know that's a loaded question, but as you're starting to make sense of that landscape.
So digital fitness is a really interesting segment of the market. I would put it into that emerging bucket that we talked about. There's tons of opportunity for long-term growth, and it's been a really exciting one to follow because this innovation that we're seeing is happening real time. I really like the category because I think digital models have the greatest ability to scale, versus brick and mortar counterparts, and can become the most accessible to the end consumer, both from a geographic as well as financial standpoint. So really that TAM is the largest. And not only are you catering to folks who only want to work out at home, but you're catering to the consumer that is supplementing a brick and mortar workout with digital workouts at home. So, there's a lot of room for growth, and I am very bullish on the segment. I think there's room for multiple business models, and people talk about the digital wars, and I think there's room for the streaming model, which is more financially affordable. And then there's the connected fitness model, which comes with equipment and streaming content, and offers the consumer something enhanced and different. And I think there are different models that cater to different consumers. So you may have a Planet Fitness consumer that's paying $10 or $20 a month and wants to supplement what they're doing with digital content. And for that consumer, a more accessible $10 per month digital membership may make the most sense. And then you may have a consumer of a really high-end gym or a boutique fitness consumer that wants to supplement their workout at home, and they may go for a higher price point concept like a Peloton or Hydro or Mirror. So there are different consumer, psychographics and demographics, and I think there's room for multiple models to cater to all of these. There's also the question of, is digital going to put brick and mortar fitness out of business? I think there's absolutely long-term opportunity for growth in brick and mortar, as we've discussed. The consumer really cares about experiences versus things, and that shows up in the numbers when you look at spending on services versus goods over time. It is more challenging to replicate community, digitally versus in person. So there's absolutely room for brick and mortar, and I don't think digital is going to entirely replace that. Of course, there will be a little bit of a tug of war in certain segments where maybe some consumers are going to reduce their boutique fitness experience in person because they can now, have that at home as well. So yes, there will be some market share wars, but there's absolutely room for both models. And I'm excited to see where digital fitness goes. I think we're still really early. There are a lot of questions that need to be figured out. What's the right price point? Membership versus a la carte. How important is live content versus simply on-demand content? When you're working with digital, should you really attempt to create a community, or is it better to just go with a more individualistic approach like Mirror or Tonal might be doing? So I do think there's a lot to be figured out. There's a ton of innovation happening. So really excited to see where the next couple of years in digital take us.
There certainly are so many factors. And like you said, you can't, you don't have a crystal ball. There are mega trends that are influencing all this. And we can see kind of the way it's going, but it kind of has to play out. There's no other way for it to happen. This is one thing as we're thinking about all these different factors and variables that I've been thinking a lot about is there an opportunity for this to be vertically integrated, right? So one thing we covered on Fit Insider was CureFit. It's a company in India that's kind of taking this vertically integrated approach all the way from fitness to healthcare. Is there an opportunity to do that here, or is the U.S. landscape so fragmented and there's too many different brands and variables for something like that to happen?
So there is absolutely room for vertical integration, and whoever can crack the code on that will make a lot of money doing so. I think the reason it hasn't happened yet is multifold. I think it's probably a combination of management priorities and also the fact that many different verticals are still subscale. So when I say management priorities, it's really thinking about what growth is on the table that I know how to execute on versus what growth comes with some risk. So if you are a gym concept and you think you can still open several thousand units in the coming years, and you know how to open those units really well with very consistent performance, aren't you going to focus on that low risk execution instead of taking a risk on something completely different? So I think there is that risk assessment and what that means for management priorities. That said, when there's less growth opportunity on the table, I do think management teams will take a closer look at being more innovative because they need to continually find ways to drive growth of the businesses that they're leading. So part of it's priorities. And then there's also just the fact that not all verticals in health and wellness have clear winners of scale. So there are a couple of really scaled fitness players or players in nutrition and healthy food and beverage, but in mental wellness and sleep and recovery and all these other verticals we're talking about as emerging, there is a wait and see component of let's see who can really make it and who can really scale, and I want to pick the winner and only vertically integrate with that player. So there is just the fact that some of these businesses need to mature further, and then they will be probably better targets for vertical integration. So absolutely huge opportunity. Whoever does it will make a lot of money, but I think, it's a combination of priorities and lack of scale in some of these categories that have prevented that from happening to date.
Yeah, we'll certainly be keeping tabs on that as the industry continues to evolve. But with that, I just want to say thanks again so much for joining us. I appreciate you taking the time. And I think so many of the things that we touched on today will be so valuable to the listeners. So I'm just grateful for the opportunity to chat.
Thank you so much for having me. Look forward to our next podcast in a couple of years.
Stay tuned.
All right. Thanks so much.
Thanks, everyone, for listening to today's episode. For more from Fit Insider, visit insider.fit.co and subscribe to our weekly newsletter for insights and analysis on the business of fitness and wellness. Then, go ahead and subscribe, rate, and review the podcast. See you next time.